We just learned about present value and why it's important and where it came from. We're going to apply it to the present value of and pricing of a bond right now. So first of all, I've given you two little mini present value tables. People don't use that formula I showed you. They use a table. And here's just a part of two tables, a present value table and an annuity table. And we're going to use them both and you'll figure out what is what. So, number one, what is the present value of $1,000 received in 5 years with a 12% discount rate? Well, obviously, it's going to be worth a lot less than it is today if it's going to be 5 years from now. How are we going to find it out? Well, we're going to go to our table, go to our 12% column, our 5-year row, and here we go. 0.567 is our factor. So to figure this out, we're going to take $1,000 times 0.567, and we're going to find out that the present value is $567. What does that mean? That means $1,000 received in 5 years, if I have a 12% discount rate, meaning I can earn 12% on my money, is worth $567 to me today. If I have two investments that I'm going to receive in the future, I can bring them both back to today and say which one's worth more today. That's the one I'll take. Let's try number two. You try it. Pause this video for a second and figure out the present value asked for in number two. Let's see how you did. What's the present value of $5,000 received in 4 years with a 6% discount rate? We're going to take $5,000. $5,000 times our factor. Our factor is 6%, 4 years. 6%, 4 years. 0.792. 5,000 times 0.792, $3,960. That's what receiving 5,000 in 4 years is worth to me today. All right, let's look at number three. What's the present value of receiving $1,000 per year for the next 4 years with a discount rate of 9%? Well, if I receive the same amount periodically, that's called an annuity. So here's the table on the right, present value of an annuity. So I could do number three by figuring out what the present value is after year one, after year two, after year three, and after year four, and adding them up. Or I can use the annuity table, which adds the factors up first. I can only use the annuity table if I'm receiving the same amount in each payment. In this case, I am $1,000 a year. So it's a 9% discount rate. I'm going to go to my 9% column. 4 years, my factor is 3.240. So to figure out what it's worth, I would take my $1,000 a year times my factor of 3.240, and I would find that it's worth $3,240. $3,240. Receiving $1,000 a year for 4 years with a 9% discount rate. Okay, let's move on. Let's use this information to calculate the price, the selling price of a bond in the open market. And it's going to be based on the comparison of the market interest rate and the stated interest rate. Number 4 then. BOCO Incorporated issues a $20,000 bond January 1st, 2015. Its stated interest rate is 10%. The market rate is 12%. Rates have gone up, so the value of this bond will have gone down. And it's due in 2 years. Pays interest twice a year. What's the market price? So the first thing is, what are we trying to figure out here? A bond is worth whatever the cash flow is to you. So that's what a bond is to you. An investment is. It's the return you receive. So you give the company $20,000, and what are they going to do for you? Well, June 30th and December 31st, they're going to send you a check, and then at the end, they're going to give you your money back. So let's figure out what they're going to send you. June 30th, what are they going to give you? They're going to send you an interest check, and that interest check is going to be, I didn't want to do that. That interest check is going to be right here. $20,000 is our bond amount. Boom. 10% is our interest rate. Now, why did I divide it by 2? Did I lose my mind? No. We're going to get paid twice a year. So you don't get 10% a year. You get 5% every 6 months. 10% divided by twice a year. So 20,000 times 10% is 2,000 divided by 2 is 1,000. So we're going to receive a check for $1,000 June 30th, December 31st, June 30th, December 31st. 4 checks we're going to get. Then on December 31st, 2016, they're going to send us our 20 grand back. That's what the bond's worth to us, cash flow. Now, the next thing we have to do is bring that money back to today using the present value concept. And we're going to adjust our cash flow not by the stated interest rate. That's how we calculate it. We'll have to adjust it for the market rate of 12%. So how are we going to do that? We're going to do it using our present value table. Here we are, present value table, 12% column. Oops, but that's 12% a year. We're getting paid every 6 months. So it's not, so 12% a year works out to 6% every 6 months, or 6% twice a year. Since we are going to get our interest twice a year, we're not going to use the 12% per year column. We're going to go over here and use the half a year column, 6%. What if you got paid 4 times a year? You'd use the 3% column. What if you got paid 12 times a year? You'd use the 1% column. Simple enough. So from the 6% column, the first present value is 0.943 for the first payment. Then the second payment is 0.890 as our factor. Third payment is, our factor is 0.840. 792 is our fourth factor. Now, we're going to receive our $20,000 at the same time we receive our last interest payment, so we can use the same factor. So there we go. We've applied our 12% factors, 6% every 6 months, I should say. We put them in our table, and now it's time to do the math. Well, I've tried to make the math pretty easy here. That's $943. That's $890. That's $840. That's $792. That's $15,840. So that's bringing this money back to today. Now let's add it up. 15,840 plus 792 plus 840 plus 890 plus 943, $19,305. That is the value of that bond to someone if the stated interest rate is 10, the market rate is 12. Got it? Okay, flip this sheet over, please, and look at number 6. I'm going to ask you to do the same thing. The only difference is it's only a $10,000 bond. And this time the stated interest rate is 12 and the market rate is 10. So what column are you going to use if the market rate is 10 and we pay interest twice a year? You're going to use the 5% column, right? You're going to divide it by 2. So go to it. Pause the video for a minute and give this a try. Let's see how you did. How much payment are we going to get? Well, the stated interest rate is 12%. It's a $10,000 bond. $10,000 times 12% interest is $1,200 for a full year, but we're going to get it every 6 months, so we're going to get $600 twice a year. $600 every time they send us a check. And then finally, they're going to give us our $10,000 back. Okay, now let's bring it back to today. Market rate's 10%, so we're going to use the 5% column. 952 and 907. 0.952. 0.907. What are my last two factors? 864 and 823. And we can use 823 for the last one too. Okay? So let's add all this stuff up and see what you did. 952 times 6,000. 571.20. 600 times 0.907 is 544.20. 600 times 0.864 is 518.40. 600 times 0.823 is 493.80. And lastly, 10,000 times 0.823 is 82.30. So what's the value of that bond? It's 82.30 plus 493.8 plus 518.40 plus 544.20 plus 571.20, 10,357.60. You're saying, wait a minute, that's more than the 10,000. Sure it is. Market rate went down. Our bond's more valuable, so it's a little more valuable than the face value. Okay, the last thing I want to show you is how to do this when you have even cash flows. You see, we have an annuity here. Same thing payable each payment. We're back on number 1. Number 4, $20,000 bond, and we get the same thing every payment. So it's an annuity. So I could use my annuity table. So for years 1 and 2, I'm going to get $1,000 each payment. I'm going to get 4 payments, and I'm going to adjust for the market rate of 12%. But am I going to use 12? No, it's twice a year. I'm going to use 6. So I'm going to go up here to my annuity table. 6%, 4 payments, 6%, 4 payments, 3.465 is my factor. Then I'm going to get my 20 grand back. Going to use the same factor there though, 792. So let's work it out. That's 3465. The math's easy. This is 15,840. If I add them up, 15,840 plus 3465, I get 19305. Phew, the same answer. Just a little faster. Now, it's not a big deal if you have 4 payments, but if you have a 30-year bond that's payable 4 times a year, that's 120 lines in your table. You can save a lot of energy by using the annuity table. So take a second, pause the video, do the one on the back using the annuity table. Okay, you can see that I'm filling in some of this. The last thing I haven't filled in is the present value factor from the annuity table. The market rate's 10%, so and the interest is paid twice a year, so I want to use the 5% column for 4 payments. 5% column, 4 payments, 3.546 is my factor. 3.546 times $600 is $2127.60. I add that to 8230 and I get 10,357.60. The same thing I got up here. So that is a little bit on present value and how to use it to calculate the market price of a bond. If you weren't 100% sure, print yourself out another blank one, give it a try, watch the video again.